Defying the stereotypes, breaking the rules. You can't tell me what is for me. Yeah. You got a lot more behind those pretty eyes, but you gotta let the world see. Yeah. So shake it up. Now is the time while you're waiting. You're not good enough. Now is the time while you're waiting. What are you waiting on? Don't let them bring you down. But they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Oh, don't let them bring you down. Don't let them bring you down. Oh.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the NASDAQ stock update for September the 2nd, 2020. And we'll get this going soon. Welcome to our live stream today. Isn't technology a wonderful thing? Sometimes it works, sometimes it doesn't. But with the age of the coronavirus, sometimes it works better than others. We have some fantastic stocks to talk about today. DocuSign is one, and then we're also going to talk about another one called DexCom. So let's get right to it and start talking about the different stocks that we have today. I want to remind you about one thing, though. As we go into the stocks that we're going to talk about today, let's look at the spaghetti graph of what happened in the market today. Everything is up. It seems like it's a never-ending growth upward. But I have to tell you, even though that you might listen to David Portnoy from Barstool Sports, and he says stocks always go up, it's going to go down at some point in time. If you've lived more than a year and watched the stock market, you know that that's going to happen. But let's look and see what happened with the two stocks that we're discussing today and what happened with the NASDAQ itself. When we look at DexCom, we'll talk about what DexCom does here in just a moment. It was up for the day. It got a pretty good bump, up 6%. You know, that's kind of hard sometimes to see a stock go up. I remember in the age of talking to clients and say, hey, we want to help you get a double-digit rate of return. And then there are other clients out there that are saying, I'm only getting 1%. And you see a stock go up 6% in a day. Let me tell you, there's a difference in between some of this investment strategy information. We're not going to teach you how to be speculators. We're going to teach you how to be investors. So ignore the challenge to try to get that stock's gain in one day. It was up for the day. But when you look at the other side of the coin, we see that DocuSign, although DocuSign is a rocket stock, I have to tell you, when you see what's happened to this stock over the past 12 months, you're going to be utterly amazed. Yeah, it was off 1.35%, but for the year, it was up tremendously. The NASDAQ itself almost got out a full percent. We don't have it thrown up here, but the Dow Jones Industrials hit a big hallmark today at 29,000. When we look at the companies and we discuss what they're doing, DocuSign, you may have used DocuSign. I've used DocuSign in the past. I've been in the insurance and investment business for a long time, and there were so many papers at one point in time to sign and to get clients to sign and everything else. DocuSign has really been one of those companies that's been propelled forward by the coronavirus pandemic. They've been moved forward light years in their value because their usefulness is dramatic. Now, the one thing that's going against, I think, DocuSign is the fact that they're really a one-product company. There's not a lot of diversification. Yes, they do have a platform, a working platform to help clients monitor and keep going with their signature process, but it's really a one-stop shop. When we look at what happened today in the realm and the spectrum of the past year, if you follow the dancing cursor, you see what went on over the past year, and that was right here in between the two time periods of February and March. That's when the market went. Now, the stock that I've thrown up here on the screen is not DocuSign. I put their competitor, Adobe, because there's really only two companies out there that are very competitive in the market. There are a couple of others that are out there that are around, but there's not that any that have as much prominence in the market and as acceptability in their e-signatures as Adobe does and also as DocuSign does. This is what Adobe did over the past 12 months. When we look at it with the S&P 500, it's really kept up with it. But are you ready? Hang on to this. This is DocuSign. DocuSign just puts the rest of them in the dust. It's amazing. You look at it and you go, wow, that's amazing. And then when we look at the numbers, we go back a year ago on September the 3rd, that was a Monday when the market was open. DocuSign closed that day at $45.57 per share. Today, it closed at $265.16 a share. That is an astounding 481.87%. I'm going to say it again because it felt good. 481.87%. Mr. Peabody when he was in the Wayback Machine and they would go back in time. I don't know, maybe it shows my age, but the point is, if you could go back a year and invest, you'd be making a tremendous amount of money. If you had the crystal ball to be able to say, I'm going to go from today and I'm going to repeat that in the next 12 months, I would not be taking that bet at all. It may be able to, today what I want to do is I want to help you to understand, is this the kind of stock that you want to hold for the next 10 years? Not is this a stock you want to buy today and sell tomorrow? This stock still has some room to grow based on the research analysts that are looking more in depth at the profitability potential for these stocks. And we're going to talk about what the analysts are thinking in just a moment. When we look at this stock, we are going to compare it to the S&P 500 because we talk about the beta of a stock, and the beta is the volatility. It's the up and down of that particular stock. It's a little out of whack when we compare it to the S&P 500. So we're going to use another statistic to look at it, and that's going to be the price to earnings ratio. When we look at the beta for this stock, for DocuSign, it's only 0.85%. So statistically, it's about 15% less volatile than the S&P 500. However, it's got a lot of potential volatility in it because the price to earnings ratio is huge. Let's look at that. The PE ratio, the price to the earnings, is 588.24. There's a lot of room for loss in there when we look at what the earnings are based on the price of this particular stock. The average S&P 500 stock right now is 30.76. So that should give you a little bit of an understanding that there's a lot of room for this stock to lose and to come down. So is it a good stock to invest in today? Let's look at what the analysts are saying. But first off, let's look and see kind of what happened from this standpoint and look at some market news. Okay, what happened to DocuStock? You see that the stock in itself ended up for the day. But what happened during the day, there was a lot of things going on. Remember when we looked at the graph just a moment ago and we saw the big bump that came up? The big bump that came up was because Oppenheimer analyst said that they were going to raise the expectation from $200 a share to $300 a share. That gave it a big bump for the morning, but then it lost a little bit during the day and lost some of its steam from that standpoint. When we look at what the analysts are saying in general, this is what Morningstar is saying about DocuSign. They're pegging the fair market value at 102. Now, remember, just a minute ago, we talked about Oppenheimer is actually pegging their fair market value at 200. So that's a little different as far as that goes. They're looking at it at 200 and expecting it to go to 300. But when we look at what the fair market value is based on Morningstar, Morningstar is saying it's only 102 when it's right now at 265. What that translates into for Morningstar, and a lot of you hear me say this every day. If you listen to me a lot, you hear me say this when I say that the stocks are not like a restaurant. It's not like a 4-star restaurant. It's going to be a 1-star, 2-star, 3-star, 4-star, 5-star based on the valuation of the stock in itself. So keep that in mind when I tell you that this is a 1-star stock. That doesn't mean that it's bad. That means that there's some speculation on whether there's much potential for it to go forward. And we'll talk about that when we talk about the moat in just a moment. When we look at what some of the analysts out there are saying about this particular stock, there's really about 13 analysts that were polled for this. And what most of the analysts are saying is that it's a strong buy. We have 8 analysts that gave it a strong buy. 1 was moderate and 4 said that it was just a hold. But I want you to remember, please, I'm not giving you information to say, go out and buy this stock today. I want to help you decide whether that this is going to be the type of stock that you want to hold for the next 10 years, not for the next 10 minutes. The point is that when you're retiring and investing in stocks, there's really only 3 reasons that you're going to invest in those stocks. One is for the growth, obviously, and I encourage you to consider using a strategy that's called bucketing. What bucketing does is you take it, you segment your money out into buckets, hypothetically. And you would say, if I'm going to retire at the age of 65, I want to look at a 10-year window from 65 to 75. That's going to be my first bucket. Then from 75 to 85, it's going to be my second bucket. Then from 85 and up, we're going to expect that you're going to have a very long, happy retirement. Now, when you get to the point of that third bucket, that's 20 years from now. So 20 years gives you enough time to be able to make it through all the different market cycles and to tolerate the losses that may happen and take advantage of the gains that are there. So when I talk about the potential for these stocks, I want to help you understand that, yes, it gained over 400%, but we want to look at the potential for this for the next 10 years. The other thing that I encourage you to think of is this. The 2 stocks that we're talking about today are unipurpose stocks. They have one purpose. When we look at DocuSign, it really has one purpose. The purpose is to sign documents. When we look at DexCom in a few moments, it's a glucose monitoring company. They have the hardware that does that also. But the technology that they use is for one thing. If that one thing goes away or a competitor comes and makes something that's better than that, then that stock's value is going to be in the tank. So we have to think that when we're using unipurpose stocks, that you want to make sure that you're diversifying, even though that if you feel that the long-term potential is there for that stock, so that just in case one of them doesn't work out, that it's going to be okay. It's not really going to endanger your entire portfolio. I listened today to on Fox News, on Fox Business, Charles Payne and Dave Portnoy from Barstool Sports did a town hall. And I thought that it was actually really pretty good. And you look at Charles Payne, and Charles Payne really represents, I think, the long-term investor's perspective. Yes, he'll help you to find some stocks and give you some advice like I would that might help you in the moment, but he's probably more focused with clients over the long term. Dave Portnoy, on the other side, started out his business from the perspective of that sports wasn't on TV anymore in March, so they went into day trading. So anyhow, keep that in mind when you look at this. And I do agree with Dave Portnoy on this issue. If you're going to be speculating, don't put any more money into a speculative issue than you can lose at all. On the other hand, if you're going to be investing for the long term, you can probably put your money in there and be aware that it's going to have ups and downs. But if you strategize, you can minimize the possibility of loss. Remember, I said minimize. I didn't say that you're going to eliminate it. You can't eliminate risk. The only way that you can eliminate risk is to get out of the market and buy something else. You can minimize it using the strategies that I talked about through diversification. And you want to do that when you have unit stocks, kind of like DocuSign and DexCom, which we're going to talk about in a minute. So let's get back over to the stocks that we're talking about and bring you back into it. Okay, when we talk about a moat of a stock, this is what I'm talking about when I'm discussing the moat. Watch this. The moat of a stock is going to be the sustained potential for profitability. If a company has a wide moat, then that means that it has a wide potential, a greater potential for sustained profitability. If a company has a narrow moat, as does DocuSign, when they have a narrow moat, they have less of a possibility for sustaining their profitability. Now, in a moment, we're going to talk about DexCom. DexCom is one of those companies that does not have a moat. So we're going to talk about it in just a minute. The reason why that DocuSign does have a moat, but it's not a long extended moat, is this. They do have a benefit of switching costs. Yes, it takes some money to switch services. And there are actually some companies out there that are spending $300,000 a year on DocuSign just to use their services. For a company of that size to switch everything that it's doing takes a lot of effort. So switching cost actually adds to the sustained possibilities for profitability. The other thing is when you go switching signature companies, you also bring in the risk of loss from data, and that's an operational risk. They offer a workflow platform too, which helps to track what's going on. So those are all things that add to the moat that's available. I've been doing that every day. I apologize. So let's move on. We talk about dividends in stocks. This is not a dividend stock. So let's just move on from that standpoint. On other days, we'll talk about stocks that have dividends, not this day. Okay, let's get into DexCom. DexCom is a really interesting company. It's another company that's been propelled forward because of the coronavirus pandemic. They have a glucose monitoring system that allows diabetics to monitor their glucose levels and report them. They can report them to their doctor, and they don't have to go in for blood tests. That's significant because it allows them, these are people, if you're a diabetic, you're probably more worried about the coronavirus pandemic than someone who's not, because you have a chronic disease which could possibly make you more susceptible. So people in that situation are looking for ways to social distance, and that's what DexCom does. DexCom has actually benefited from the coronavirus pandemic because more people are utilizing their service. It's a continuous glucose monitoring system. They closed the day up quite a bit. Unlike DocuSign that was down just a little bit, the DexCom closed up, and you might kind of be wondering exactly why did that happen. So let's take a look and see. Really, when we look at why DexCom jumped up today, let's look at what they reported on the Motley Fool. And it's really interesting. It had a 5.7% jump by the afternoon. And the only reason that they had the jump was because of investors who were anticipating that it was going to continue moving on. Now, let me tell you a little bit about my philosophy on this. And you can agree with me or you can disagree with me. But DexCom really is a medically related company. The sustainability of their profitability is going to be tied a lot to the elections. Yes, it's going to be tied to who's going to possibly be in office, whether it's going to be Democrats or Republicans. The reason is it's a medically related stock. The value of their service will be regulated if we have a medical system that's more controlled by the government. If they control what is going on from a medical standpoint, they also limit the potential for a stock like this to continue to grow. That's why when you see medical stocks that are continuing to grow like this, what I feel is that this is an indicator that the markets, especially the healthcare markets, are saying that things aren't going to change. We don't think that there's going to be a change politically. It's going to continue the way that it is. Now, whether that the House of Representatives goes to the Senate, goes like the Senate and is Republican or not, I don't know. But if we look at what the indicators are from the market, what the market's telling us is that the Republicans are going to maintain control of the Senate and they're going to control the White House too. So keep that in mind when you look at stocks and you're thinking of, I want to invest in this stock, especially medical stocks. As we get closer to the election, if that turns the other way, you're going to see medical stocks start to suffer because controlled prices based on something like Medicare for All will have a detrimental effect on medical stocks in itself. So let's get back a little bit over and talk about this stock a little bit more. Okay, I want to show you how DexCom compares to some of its competitors that are out there. When we look at the graph that's here, obviously DexCom's much higher because it's got over 160% for the past year. But when we look at it in comparison to its closest rivals that have similar products, one would be Abbott Laboratories. Now, when I talk about the moat in a minute, I'm going to tell you that DexCom really doesn't have a moat because they haven't built in anything that is a significant reason why people are going to stick with them. They've been basically expanding their market share, which is good, but from a standpoint of how they compete with companies like Abbott Laboratories, someone can go to Abbott Laboratories for their service pretty easily. It's not that hard to do. So will this continue on? I don't think we're going to see a repeat year of 160%, but it probably has a potential for continuing on and being a good investment for the next 10 years, but how it's going to do in the short term is still questionable. Medtronic is another company that has a service that's very, very similar to the glucose monitoring system that DexCom offers. But you can see if you follow the dancing cursor, its stock really hasn't changed that much from that standpoint. But you have to understand that Medtronic and Abbott Laboratories have other products that they have in the mix, which is adding to the impact on their stock's value. When we look at DexCom, DexCom has one product. That's it. They're a uniproduct company. So that's why I'm talking to you about having diversification so that just in case if you invest in a stock like this that it doesn't work out, that you've got some cushion in there from a value standpoint. When we look at the S&P 500, we're going to talk a little bit about the beta of DexCom, but it's not going to give you as much of an indicator as the PE ratio does. Remember, the S&P is at 1, and you can see it right here in gold. But when we look at the value of what's happened with DexCom, this has been another story that's been like DocuSign. It's not the rocket value increase over 400%, but it's really been pretty good. A year ago, it was $170 in value, and today it closed at $447.71. So we see 163.36% increase. That's huge. Now, will it continue? I wouldn't be a betting person that would say that this is going to continue for a long period of time, but I do think that they've got some potential for the long term. If we're looking at a stock for growth, for that long-term bucket for investing for retirement, if we put this in with the strategy of direct indexing and we're investing in something like all 100 stocks of the NASDAQ 100, I think that this is a good stock for the mix. But you got to remember something in all of this, and you'll read this in the disclosure if you stick around at the very end. I have a disclosure that's important. That the past performance of these investments is not a guarantee of their future results. You have to keep that in mind. Okay, let's talk about the beta just for a second since we've talked about this. So we'll go through this real quick. Oh, this is the first thing I want to do. Why do these companies increase in value? Because of earnings. Earnings has a huge impact on it. This was the Q3 third quarter earnings. It had a 261% increase over what was expected. When we look at the fourth quarter earnings from last year, it had a 53% increase. When we look at the first quarter for this year, even though that there was a coronavirus market pandemic crash, it went 340% over what the analysts were saying. And most recently, it went up 154% over what analysts were saying. So my point is that earnings is really what's driving this. If they can continue to earnings, then you have some potential for continued growth going on. When we look at the beta that's in here, yeah, it's less volatile than the S&P 500, but the PE ratio, wow, 193.4. Remember, the average beta of the Standard & Poor's 500 is a little bit over 30, so there's a big difference from that standpoint. Okay, moat. Let's talk about the moat. Remember what the moat is? The moat is the sustained profitability, the potential for it. When we look at DexCom has no moat. The reason is they really don't have a competitive advantage that's out there. It doesn't cost that much to switch, and there's no integration with medication. In other words, there's no notification to the doctor that they should use a medication, and the medication is not controlled by DexCom. When you look at companies like Medtronic or Abbott Laboratories, that might be a different story from that standpoint. They do have a wider moat in that. When we look at what the analysts are saying, the fair market value on this stock is really pegged at 85 today. That's obviously wrong when I look at what the values are. So we're going to go past that. When I look at what's happening from the standpoint of what the analysts are saying that this is a strong buy. Out of the 20 analysts that are polled for this particular survey, we see that 15 of them are still saying that there's a sustained, they're looking at the potential for those earnings per share to continue. And if they can continue, then this is a strong buy. A moderate buy was given by one analyst, and there are 4 analysts that are saying that we're just holding from that standpoint. Now, I want to remind you, just like I do with all the different stocks when we talk about what analysts are saying, that this is not a recommendation for you to go out and buy the stock. This is a suggestion for you so that you can see how this would integrate into your retirement plans so that you could have money for when you're 85 so that you can have value built up. That's what we're trying to do from this standpoint in using this particular stock. Another thing is, remember that this is not a dividend stock. So if you're looking for stocks to pay you dividends, this is not going to fit in a bucket from that standpoint to help you out there. This is going to be a stock that you're going to buy for long-term growth. Keep that in mind when we're looking at everything. Okay, so we've really come to the end of everything, and I'll remind you, like I do every day, that we design financial plans that can help you avoid running out of money during retirement. And if you want to talk about how stocks like these can be integrated into your retirement plans, your personal retirement plans, then reach out and contact me. The best way to do that is to go to my website at richardsfinancialplanning.com. Go down the page. You'll see it. It's a couple of times on there. You'll see this teal colored button, and it says schedule a call to learn more. You can schedule a call. I'll have a 20-minute conversation with you. You can ask me any questions you want. There's no cost to it whatsoever. But go to that website and you can set it up from that standpoint. So the last thing that I'll remind you of is that I have a disclosure that's coming up. If you have questions and you're listening to this on replay, remember that you can always type your questions in. If you're listening on YouTube, make sure that you subscribe, because we have more information that comes out. I post other different information, other different ideas about retirement planning and investing that might be able to help you out. Hit the subscribe button and you'll get notified when everything happens and comes available to you. If you're listening on Facebook, like us, and you'll know that we're going to be on every day around 5 o'clock, sometimes a little later, if things aren't working out as well as they should. The last thing that I'll tell you is, if you're listening on Twitter, make sure that you let us know what your comments are, or on Periscope, that is. But we'll see you tomorrow. Stick around for the disclosures and have a great day.